So lovely to see a room full of investment trust enthusiasts, so thank you all for coming. I thought I would start with the UK economy. And this matters more to me than it would for many UK fund managers, because the types of companies that I invest in are generally smaller businesses that are more domestic. So often, when you hear UK fund managers stand up, they say, well, actually, it doesn't really matter what happens to the UK economy, because the FTSE All-Share is very international. Well, it matters to me. So let's start with the UK. And the UK has been doing gently better than low expectations. So what's the evidence for that? If you look at the top chart, what this says is every month of this year, how much did economists think the UK economy was going to grow by? So at the beginning of the year, the economists on Bloomberg, on average, thought the UK economy would grow 0.3%. Now, bear in mind, the second half of last year was a recession. So if we'd only grown 0.3% this year, that would have been pretty dire. That's a pretty pessimistic outlook. Now, it turned out that was too pessimistic. The first 2 quarters of this year, the UK economy grew 0.6%, 0.7% each. So now the average economist is forecasting more like 1.2%, 1.3% growth. So we want to be clear, not stellar. We're not talking about the US, we're not talking about China, whether it can get to 5% or not. We're talking about 1.2%, 1.3%. But it's a lot better than essentially nothing. And the same happened last year. Last year, I came back from maternity leave at the beginning of last year. People thought it would be a recession, a deep recession, and actually it wasn't. Last year, the UK economy sort of bumbled along and did basically flat. So again, not stellar, but better than low expectations. So something about the UK economy seems to be more resilient than the average economist thinks. So why is that? I think it's to do with the consumer. And remember, consumer spending is roughly 60% of GDP, so it's really the consumer that moves the needle in any one year on what the UK economy does. And consumer balance sheets, so what this top chart is saying is where are consumer balance sheets in aggregate? And it's always in aggregate. This isn't any one individual consumer. There will clearly be people that have, unfortunately, lots of debt, and there will clearly be other people with lots of savings. So this is an average, but it says if you take savings minus borrowings, where is the UK consumer since the financial crisis? And what this chart is showing you is that the consumer has been gradually paying down debt. And this includes mortgages, by the way, been paying down debt since the financial crisis. Some of it will have been forced because the banks have been very conservative since the financial crisis. The banks have been trying to delever. So the consumer has, in a way, been forced to do this. But they have done it. They've paid down debt most years. And then you can see COVID happens. And everyone gets the furlough schemes and the benefits. And being the typical UK consumer, they squirrel it away. That's that sort of dip up towards the top. They put it in their savings. They don't go out and spend it. And it means that where we are right now, the average consumer basically has neither savings nor debt. Now, again, it's an average. There will be people with lots of savings. There will be people with debt. But the average consumer is in a much better balance sheet position, if you want to think of it that way, than they have been for a long time. And then if you turn to if you want to think of it this way, this is how I like to think of it, their P&L, their profit and loss, they are back in real wage growth. So average private sector median earnings growth is around 4%. Inflation is around 2% at the moment. So people are seeing roughly 2% real wage growth. So their balance sheet is fine, and they're back in real wage growth. So the consumer is in a good position. By the way, this is slightly different from the States. So there's something different psychologically happening between the UK consumer and the US consumer. The US consumer, when they got their equivalent of the furlough scheme, went out and spent it. And that really helped the US economy, whereas the UK, for some reason, we just went, oh, thanks for that, and we're just going to squirrel it away. And you can see it in our savings ratio. So something is happening with consumers not having the confidence to go out and spend. And you can see it in consumer confidence surveys as well. When you ask consumers, most of the time they say, yes, I think things are getting gently better. But if you ask a slightly different question and say, do you have the confidence to go out and spend on a big ticket item, whether it's a house or a car or even a sofa, they still say no. So something isn't quite hitting with consumer confidence, but they are in the position to go out and spend when something clicks in terms of that confidence. So the underlying health of the economy is better than we think. Now, That's not to say, by the way, that there aren't things wrong with the UK economy. Things like productivity have undoubtedly been poor. We need businesses to go out and spend more on investment. So there are things, don't take me wrong, there are things that can be made better about the UK economy. But the consumer is in better health than I think is widely recognised. So that's the economy. What about the market? And I find it really interesting that whenever I do a session like this, or whenever I do individual investor meetings, the first question people always ask me, including really recently, is what's going to be the catalyst for UK equities? What's going to make UK equities do better? And I kind of want to show them this chart, because UK equities are up almost 20% over 1 year. And I sort of slightly cheekily put one of our investment trusts in here to go, well, actually, if you've had an active manager, you might have done slightly better than that. So why are people still asking me what the catalyst is when you've had an almost 20% up year? This is classic kind of wall of worry stuff. We've had, what have we had? We've had the general election, we've now got the budget, and yet, UK equities have actually done absolutely fine in any absolute sense. So why are people still asking me? I think this is why. I think it's that the US is still this sort of massive overshadowing across global equity markets. So people are still feeling aggrieved that, well, yes, UK equities are up nearly 20%. Oh, but I still could have done better in the US. I still could have owned Nvidia. And I think, we can't compete in the, let's be real, we can't compete in the UK with Nvidia. We don't have a massive, massive company growing its earnings 100% in 1 year. But UK equities, what we do really well in the UK equity market is a different type of company. What I've described as a compounder. And I'll give you an example in a couple of slides, but the best performers in my funds over the very long term are things like Cranswick, which is a meat processor. It does chicken and porks. Or Hill & Smith, which is a galvanizer. It literally takes things like poles and dips them in zinc. These are not glamorous businesses. They're not Nvidia. But they churn out good returns year after year. I like to think of it as a proper sort of hare and tortoise situation. We don't have an Nvidia. But we do have some great compounder businesses that, if you're patient, can generate very good returns over the long term. Now, normally, when I put up this slide, I say, look, the UK is at the bottom, and no one likes us, and everyone sells us. Now, actually, surprisingly, when I checked this chart the other day, I was amazed that the UK finally is not at the bottom of this table. That actually global fund managers are now saying we have more in the UK than we've had historically. I would love to sit here and say that we're seeing this in terms of inflows into the UK equity fund market, because we are not. But something is clicking somewhere. Maybe it's, well, no, I'm not going to be arrogant and say it's people like me. There are lots of other fund managers, UK fund managers, that are going out there presenting a really good case for UK equities. And it's nice to see that someone somewhere is listening. But we are not seeing it yet in terms of flows into the equity market. So what have been the catalysts? Normally when I stand here, I say, okay, what could be the catalyst? But I think given that we're talking about a year that's up almost 20%, what have been the catalysts, and are they still there? So the first catalyst has been valuation levels, and this has been the case for a long time. I think valuation almost acts as a sort of foundation for everything else to move off from that. So UK valuations are still below the rest of the world on almost any metric. So what I think is important, when you hear fund managers, UK fund managers stand up and say UK equities are cheap, we're not just picking one individual data point that suits our cause. The UK equities are trading on a valuation discount pretty much no matter what you use. So price to earnings, we're at 12 times. The rest of the world, basically the US, 20 times. We're paying you an almost 4% yield. The US, less than 2. Our price to book is lower. So the point is that we are not just picking one metric, it's across every metric. And this includes, by the way, if you do sector-adjusted PE, because the UK equity market is different. Like I said, we don't have a Nvidia or an equivalent of Nvidia. But even if you do it on a sector-adjusted basis, UK equities are at a roughly 20% discount to the rest of the world. So that valuation case remains and has remained for a long time. So what's new? What's coming on top of that? Share buybacks. Even small companies now are announcing share buybacks. So I've got companies on AIM, even, the likes of Johnson Service Group, which is textile rental, is buying back its own shares. Company boards have got to the point where they are so frustrated with their own valuation levels and they feel vulnerable to takeovers, which we'll talk about in a sec, that they are becoming their own net buyer. So in the absence of, I said just now that the flows aren't coming, the companies are thinking, okay, well, how can we address this ourselves? And they're buying back their own shares. So that's the first catalyst. The other one is takeovers. And this is both helpful and unhelpful. And I'll explain what I mean. So this valuation discount is visible not just to us, but to other buyers of these companies. So we have seen in the last year an unprecedented number of takeovers in the UK. For one of the trusts that I managed, we were having a takeover roughly one every 2 months, which is unheard of. And the difference now is that these are companies that are household names being taken over. So whereas this time, if I did this conference this time last year, I would have said there are some smaller companies being taken over, and I could have named them, but they wouldn't be recognised. Things like Finsbury Food, which most people in this room would have eaten something by Finsbury Food, but you probably wouldn't know it because they make things like Thornton's cakes for supermarkets. They got taken over by private equity this time a year ago, roughly. But it didn't chime with people because no one knows who Finsbury Food are. But where we are now, we held Royal Mail across the 3 trusts in our portfolio. Everyone knows Royal Mail. Royal Mail is being taken over by private equity. Anglo-American almost got taken over. These are names that everyone knows that are suddenly coming up for takeover interest. So it has been really unprecedented, the level of M&A activity in the last year or so. So all of these catalysts still remain. So how might you, as investors, get exposure to the UK? And that might seem a strange question, because you would think, well, I'll just go and buy the FTSE All-Share, won't I? But to get exposure to UK domestic PLC, you cannot just buy the FTSE All-Share. And the reason that I say that, if you look at the top chart and look at the orange line, the FTSE 100, so the biggest companies in the UK, are only about 35%-ish actually in the UK. If you think about things like the AstraZenecas of the world, the Shells of the world, they're not really UK businesses. Yes, they're listed here, but they're not domestic businesses. To get exposure to domestic businesses, you need really to go at least to the FTSE 250, but as you go down the market cap scale, the businesses get more and more domestic. So if you think the UK economy is doing better, like those initial slides, you won't get much exposure to that just from the largest UK companies. And what the chart below shows, so orange is domestic, black grey is international. Domestic earners, in other words, those smaller companies on average, have underperformed hugely in the period. No prizes for guessing what happened in mid-2016, but that's clearly the point at which the graph starts to diverge. Domestic companies have underperformed, international earners have outperformed. And it's a huge scale. We're talking 30, 40% underperformance over that now near 10-year time horizon. So if you think the UK economy is doing a bit better, you have to look beyond the FTSE 100 to those smaller businesses. Just as a tiny, tiny pitch, the trusts that I manage do go down the market cap scale. So something like Lowland would have more like 55% exposure to the domestic economy, compared to that more like 35% for the benchmark. And this is effectively the same graph when viewed through a different lens, but what often surprises people when I show people this chart is just how bad UK smaller companies have been. So the top graph is FTSE 100, the top 20, the real mega cap, our equivalent of the Magnificent Seven. Think the AstraZenecas of the world. They've done very well over the last couple of years. No one would be moaning about a 40% total return. But look how AIM's done. AIM is the bottom line on this graph. There has been an over 70% difference between the biggest UK companies and the smallest. That is astronomical in terms of the difference in return. And that is a culmination of all sorts of things. It's not only domestic sentiment because of Brexit, it's flows, it's pressure from liquidity among fund managers. But these are companies that are still operating, still making cash, still generating earnings. And like I said, we are not the only buyers of these assets in town. So if this valuation doesn't correct itself via the equity market, there are other routes that it will correct. I was going to give you one example. Bear in mind, this is just one company example, and this is one of a portfolio. I tried to make it a sort of guessing game, and then I looked at the slide this morning and realized that I put the name of the company in the graphs. So it's not so much of a mystery as I was hoping. So this is McFarlane. It's a packaging distributor. I've got the immense pleasure of going on a site visit on Monday in Milton Keynes. This is the kind of glamorous site visit that fund managers get to go on. So this is the UK's biggest packaging distributor. So if you're something like Rolls-Royce and you need to get your jet engine, so it's a hugely specialist piece of packaging so that it doesn't get damaged, you are likely to use McFarlane. It has grown its earnings mid-teens-ish over the last 10 years or so. It generates good return on capital. It has no debt. It ticks the boxes that people say they're looking for, but the big box that it doesn't tick is that it's roughly 200 million market cap. So it's below the interest of the vast majority of UK fund managers these days. You know, even smaller company fund managers are, in reality, often medium-sized company fund managers. This, by the way, is not on AIM. It's on the main market, so it doesn't have the question marks around AIC, et cetera, et cetera. It's main market listed, but it is just below the market cap spectrum of most UK fund managers. And this would have been the same for something like Finsbury Food this time last year. But again, this is the market leader. It's cash generative. For something like an investment trust where we don't have the immediate liquidity pressures, this is exactly the kind of company that we are looking to invest in. But as I say, it's not just McFarlane. You know, I was at a conference yesterday, I met a company called Norcross that make, equally glamorous, that make things like shower enclosures. The charts would look so similar to this. And something like McFarlane is on 9 times earnings, something like Norcross is on 7 times earnings. You can buy huge swathes of smaller companies within the UK equity markets, where if you looked at the valuations in any kind of historic sense, you'd think they looked silly. And I really mean that. You would struggle to justify it. If you looked at the company and just looked at the numbers, you would struggle to justify these valuations. But this is where we are at the moment. So what are we doing? I've used Lowland here as an example, but something like Debenture would be very similar. There are opportunities, as I said, in the smaller company end, things like McFarlane. Springfield Properties is a Scottish house builder, trading below 1 times book. Something like Speedy Hire, again, trading below 1 times NAV, its NAV being pieces of kit, basically, that you put on construction sites. And in the FTSE 100, there are also opportunities at the larger company end, in our view. You know, something like Sainsbury's, which we've been adding to, including very recently, is trading on 12 times earnings. It pays a roughly 5% yield. There are a plethora of opportunities out there in UK companies, and it isn't only at the smaller company end. There are plenty of larger companies' opportunities as well. So, UK equities, rather than my normal title of kind of unloved and nobody cares, it's a slightly different story now. We have had one good year, and I'm really hoping that it's one good year, but it feels fragile. Consumer confidence is fragile, business confidence is fragile, and I'm hoping that the budget, you know, we're now thankfully only a couple of weeks away. I really hope that that doesn't disrupt the momentum that I think we've subtly started grinding into. So we have had a year where we're quietly performing better. I think the catalysts are still there in terms of valuations, buybacks, takeovers. But just a word of caution in terms of positioning, you do need to look beyond the FTSE 100 if you want to get exposure to true UK. And I'll leave it there for questions.
That's excellent, Laura. Thank you. Thank you very much, Laura. We now have opportunity for you to ask Laura some questions. So there are some roving mics in the room. If you're watching online and you want to type in your questions, then I have the technology that I can feed those through to Laura. So does anybody want to kick us off with a first question? Yeah, there's a gentleman at the back there, and then there's another gentleman down the front here.
Yes, could I ask, this year, across your portfolio, how many companies have seen their earnings estimates going up as opposed to going down?
That's a very good question. The short answer is I can't tell you the exact number, but most companies have seen their earnings nudge down. And why do I say that? I focused on the UK economy. Things like the US economy have definitely slowed. You know, there's no getting away from that. We do hold quite a number of industrials, things like Lowland and Debenture. And while they are rapidly trying to take costs out, There is no doubt that certain end markets, particularly things like autos, are slowing, and that has hurt earnings forecasts in the more cyclical areas of the market. So earnings estimates have nudged down, but not materially so. But I can't give you an exact number in terms of...
There's a gentleman in the front here had a question.
Yes, you spoke positively about UK equities, surprisingly. I have no wish to be political, but what effect did Brexit have on this? Bearing in mind that we've had to change the direction we're going in and face a full force of overseas competition, unlike EU, which we all know is in a terrible state at the moment.
Brexit was a very challenging time for this type of portfolio where we are more domestic than our benchmark, which is the all-share, and quite a lot of our peer group as well. And that de-rating on those domestic businesses has stayed, where's the chart, pretty much the entire time. There have been periods where it looks like we were getting some momentum. So just before COVID, if you remember when Boris Johnson got elected, there was a period where people thought, finally, regardless of what you think politically, you think, okay, well, we have some stability now, and domestic equities might be able to re-rate. And then very shortly, we had a couple of good months, and then COVID happened. So Brexit has undoubtedly been really difficult for domestic UK. There's no getting away from that. But I feel we are getting to the other side of that now. And when we're talking almost 10 years later, and these businesses, like I said, have still generated cash. They are still good market-leading businesses. But it was incredibly challenging, that period after Brexit. And we, along with most people in the city, got it wrong and thought it wouldn't happen. To be really upfront with you, we were naive to it, and it did come as a surprise on the day.
Any other questions? There's a gentleman at the back there, I think, and then another gentleman down the front here. Tamara, do you want to take the microphone to the back? And we'll take the question from the gentleman at the front first, because the microphone's going to get to him first. And then...
You mentioned Sainsbury's. I've looked at it many times, but there's considerable short interest in that. How do you balance that in your appraisal, please?
So the question was, how do you balance the short interest in a stock like Sainsbury's when you're making those sorts of decisions?
You're completely right, and I find it slightly flummoxing, to be honest, why there is such a short interest in Sainsbury's. And because I'm not a hedge fund, I'm not quite tuned into what is it about Sainsbury's, because the balance sheet is fine, and it's trading seemingly fine. So it doesn't put me off. I'm aware of it, but it doesn't put me off. And what you do occasionally see, and sort of occasionally I enjoy, if I'm being really honest, is where the shorts get it wrong, you can get a short squeeze. So what happened with BT earlier on in the year, so we own BT, and Alison, the new CEO, comes out at a time when everyone was short, and everyone was very negative, and says, actually, things are fine, and the cash is good, and you get the short squeeze. And that can be really helpful, actually, sometimes. So I am aware of it, but I don't really understand why or know why. Yeah.
Thank you.
Gentleman at the back.
Yes, I know you're not here to plug your trust, or indeed for us to knock them, but I'm intrigued that one of them has performed very well and the other two not so well. Can all that be explained by the valuation differences that you've been talking about just now?
So to give you a feel, so two of them, so the two income trusts, Lowland and Debenture, have performed well and fine, actually, but the Henderson Opportunities Trust is a much more AIM-focused trust. It has 45% on AIM, and AIM has been unbelievably challenging, as this chart shows, and our benchmark on Henderson Opportunities Trust is the FTSE All-Share rather than AIM. So Henderson Opportunities Trust looks very, just to be really upfront, looks difficult because it has had so much on AIM. But the two income funds are fine, actually. They're both up sort of low teens mid to date and sort of 15, 16% over a year. But I'm happy to come over afterwards and explain, but that's the difference between the three.
I have there's a question over there, and then there's another one over here. But whilst the microphone's just getting there, Laura, I have a question from somebody online,
Okay.
which is, you talked about the minimum size for investors in terms of a company. Your own, I think one of the market caps of your investment trust, this question says, is possibly low at around 350 million.
Yes.
Any thoughts on growing the size of that and growing the capital pool?
So the question is, so Lowland, as I think what it's referring to, Lowland is roughly 350 million market cap. It would be lovely to grow Lowland, and the board would be very happy to grow it. I think the challenge, as is shared with a lot of investment trusts at the moment, is that we're at a discount.
Yep.
So we're at a low teens % discount, which makes growing by way of issuing shares, etc., very difficult. But it would be lovely to be able to grow it if and when we can.
There was a question over there, I think, from a...
Yes. What did you think about the idea of a British ISA that has been canned now, or do you think that some commentators are talking about tax for encouraging UK investment via the ISA, and allowing only UK listed companies to be invested in your ISA? What do you think about that idea?
I was really in favour of the British ISA as an addition to the existing allowance, and spent time filling in the consultation, and then thought, well, that's a waste of time because it seems to have been completely shelved under the new government. But I was greatly in favour of that. I think we are very unusual in a domestic equity market to not encourage domestic equity investment in any way, really. If you look to things like Australia, they have huge levels of retail participation in their equity market in a way that we don't. And you can really see it in the differing valuations. If you look at things like the Australian banks, they're valued completely differently to how our banks are valued, because there is that domestic shareholder base. So I'm not a politician. I don't have a strong feel for what the right route to go down is, but I strongly feel that we should be encouraging investment among retail shareholders in our domestic institutions. And so I hope there are some changes made.
There was another question over there, Tamara.
You mentioned takeover activity earlier. What kind of premiums are you seeing being paid for undervalued companies currently?
It hugely varies, and it often varies depending on the type of takeover. So what I mean is private equity often don't pay a great premium, whereas if it's a peer, they are paying, in some cases, very substantial premiums because there are cost savings that can be made from the two companies. So to give you an example, something like Devro, which was last year now, which was sausage casings, got taken over by a European peer. And the premium was large, I think, from memory, it was something like 50%. And we were very happy with that. We thought that was a fair valuation for that company. Whereas with Finsbury Food, the valuation premium was low. It was something like 20% from a very low valuation. So we were not happy with that. But it's often the type of buyer that makes the difference. But it varies hugely.
I've got time for one more question, so I'm going to take one that's online. Gearing. Do you use gearing in the funds at all? And how do you see that as a tool within your toolkit?
I use gearing across all the trusts that I manage. I think gearing is a real advantage of the investment trust structure. And so when we're positive, which you can probably tell from the presentation, we are positive at the moment, we like to use gearing. So for something like Lowland, we have a low teens level of gearing, and Debenture would be similar.
And have you increased that in recent times and to take advantage of those opportunities? To
be honest, in short, no. We've had that level of gearing for a while because the valuation discount has been there for a really long time. I could have sat here with the valuation chart at any point really in the last 8 years and said UK equities are at a valuation discount. So no, we've kept the gearing for that time. Yeah.
Excellent. Just falls to me to say thank you very much to Laura for an excellent session. Much appreciated.